let's go for it. Well, my name is Wayne Sedlak, and I'm talking with a man who's considered by many across the country to be foremost expert on money and banking, why we're in the foreclosure mess that we are, the credit card mess. Mickey Paletta, you're an author, you're a researcher. Your book, Deconstructing Money and Banking, is considered by many to be a paradigm shift, a whole new revolution in thinking, and contrary to what we've been taught all our lives. Is that right?
Yes, exactly right.
You know, if I have a debt out there, and someone comes along and says, you know, Wayne, you owe $100, I'll pay it for you. Mm-hmm. And they pay the $100. From the law standpoint, the debt's paid.
Right.
Now, if the debt is paid by whomever, it doesn't matter if it's gifted, it doesn't matter, it's paid. Now, you might have to work out some sort of arrangement with the fellow that helped you out. But the fact of the matter is, if the debt's paid, it's paid. The credit card industry, for example, or the mortgage industry, they claim to loan money to people. Mm-hmm. Yet, Mickey, within perhaps days of them, let's say a mortgage, what happens to the mortgage and its note?
We got proof, Wayne, that oftentimes the alleged notes are created some 7 days to 14 days before the actual consumer signs those. They are created, and where they are monetized, and what that means is, Wayne, is they put it into the bank's account as a loan from the depositor to us. But what we have to understand is that oftentimes those notes are created before the consumer actually signs the mortgage and of the note, Wayne. They are created before.
So it's a creation. There's no real value offered. Now, what happens afterwards? The banks don't stick it in a vault, do they?
Oh, no.
They get paid. No, they don't wait 30 years for you to pay off the house and get their money back. They get paid up front. What are all the different ways they get paid?
Well, the main way now is something that they've been doing that I would believe probably since 1990, and what the term is called is securitization, where they take these notes and they put them into a trust account where they are once again paid, and now they're owned by a trust. So what it means now is that the banks now that are starting to foreclose on us don't own the note.
They've already sold it, got paid for it.
And they cannot legally foreclose because they're no longer the proper party. They've been paid.
So the person out there, the person or entity, an account somewhere on Wall Street that does own it, they're not going to sue you on the foreclosure. They let the bank do it because most people have been taught, we've all been taught, that they're the ones that, since they quote-unquote loaned the money, they're still holding it. And they're holding that note in a bank vault somewhere. That, in fact,
that's
folks,
false.
That's false.
Right.
That's why, folks, the banking industry over the past year and a half has been scrambling to get their so-called paperwork together. The media has helped them cover it very well, as people are made to know that the bank's just having some paper problems. Yeah, you bet they do. Mm-hmm. They don't own the foreclosure notes when they go to sue people on the foreclosures. More to the point, Mickey, and this is appalling. Yeah, they got paid when they sold that, long before you're in alleged default on your home, and they come to seize it. The bank doesn't own it. We've already just established that. But they got paid for it. But they get paid insurance.
Right.
They get tax benefits.
Exactly right.
So they get a tax benefit when you allegedly default. They have an insurance amount that they get for the alleged default. Is that correct?
Exactly right.
And they are not even the holders, the legitimate plaintiff in the lawsuits that the debt collectors come to represent them in. Is that correct?
Once the loan is securitized and placed into a trust, nobody knows who actually owns those notes. Wayne, it's just like an orange drink. Let's just say that you were a farmer and you sold a bushel of oranges to some firm now that buys all the oranges, and they convert that into orange juice. Can that guy say what specific 5 oranges was really his out of the orange juice?
Right.
So which means is that they can't foreclose.
That's the paperwork problem because of the way they did it. And then they come back and it's all paper to begin with. They didn't offer real value, and they get real value from you, your homes, your lands, everything.
Wayne, let me put it like this. For every loan that these bankers that create is based upon fraud. That they get repaid, that I would say 7 to 10 times. So like when you go downtown now to your major towns like Chicago, this is how these banks can afford all these 50 floor office space there, is because they are actually selling the notes that they have no money in, and now they are reaping 10 times the amount, and then when they contract the money supply, Wayne, they steal your property.
Yeah. One last thing, Mickey, it's been proven many, many times that what they'll do is they'll take the mortgage and the note, they'll bifurcate them. They'll separate them and sell them both as interest-bearing instruments. They put them, of course, they securitize them. They sell them out, again, on Wall Street, like entities.
Right.
So both the mortgage and the note become interest-bearing, and the bank no longer owns it. Is that right?
And once they're separated, Wayne, they are uncollectible.
Because they've been altered at the very least.
And
they're
one
uncollectible
without
against
the other.
Against the person. Against the person, the homeowner.
Exactly
But
right.
the homeowner is made to think he's a deadbeat, he's defaulted, and the facade goes on. Folks,
Right.
if you're interested in learning more, give Mickey a call. 717-979-3061. Whether it's the alleged, you know what I'm using the term, alleged credit card issues or foreclosure problems. 717-979-3061. Mickey Paletta of the Citizens Reform Center. Mickey, thank you very much.
Okay, Wayne, thanks.